In this example video, we're going to look at how we're going to analyze different business transactions and then use those ending balances to put together our three financial statements. So in this exercise, they give us some information about our business. They tell us that our owner actually started or established the business in the month of August, and they want us to analyze transactions A through I and put them into a grid to show that our accounting equation is going to stay in balance each time. So in A, it says they opened a business bank account with a deposit of $22,000 in exchange for common stock. So remember, you are always the business. So you're always looking at it from the business's point of view. So we as the business are getting $22,000 in cash in exchange for giving someone ownership rights in our business. And that's in the form of common stock when we're dealing with a corporation. So in the grid that they gave to us, in transaction A, they tell us that they want us to use a plus sign or a minus sign. So we are increasing our cash and we are increasing it by $22,000. So our asset, our left side of our accounting equation, is increasing by $22,000. And the reason why we're getting $22,000 is that we are also receiving common stock. We are giving $22,000 in common stock to these stockholders. So we now have $22,000 more in ownership rights of our business. For transaction B, it says we've purchased office supplies, and it says we've purchased it on account. So anytime you see that phrase on account, that is going to mean that either accounts receivable or accounts payable is involved. And an easy way to figure out if it's payable or receivable, we take our last word, which is account, and our first word, which is purchased. So if it's account that's been purchased, it's accounts payable. If it's on account and the first word is received, that would be accounts receivable. So easy kind of way to figure that out. So basically, we went to a store, we bought some office supplies, we didn't pay cash for it at the time of purchase. So again, think of it like you're using your credit card, and we are buying $1,900 in supplies. When we buy supplies, that increases an asset account for us. Our supplies don't become an expense until we've actually used them in the business. And again, we purchased it on account, so we are not affecting our cash. Our cash is not changing, but what is going up is our liability. We now owe $1,900 more sometime in the future to somebody else. So maybe that's to Visa or MasterCard or whoever we have our credit card payment with, or maybe we owe a specific business. So again, every time something happens on one side of the equation, something else has to happen on the other in order for us to stay in balance. So they want us to update our balances. So we have $22,000 in cash. We have $1,900 in supplies. We have $1,900 that we owe in accounts payable. And we have $22,000 that we have in common stock. So we do not have to enter zeros as the directions have stated there, so we can leave the rest of them blank. In part C, it says we paid a creditor, and there's that key phrase again, on account. So again, go to your last word is account, your first word is paid. So if it's account paid, it's accounts payable that we're dealing with. And when we're talking about a creditor, it's somebody that we owe money to. And anytime you see the word paid, we automatically know cash is involved because that's the only thing that we can pay anything in. So that means if we're paying out cash, we're going to be reducing our cash. It's going to be coming down. So we're going to enter in that minus sign of $1,400. And they said we've paid it on account. So basically, we've made a payment to our credit card. So we are reducing our liability or our debt by $1,400. So think about, again, making a payment to your credit card. You want to see that balance go down. So we need to update our balances here. So we had $22,000 in cash. We just spent $1,400. We're left with $20,600. We still have $1,900 in supplies. We previously owed $1,900 in liabilities. We just paid that down. We reduced it by $1,400. So we now only owe $500, and we still have $22,000 in our common stock. In transaction D, it says we earned sales commissions receiving cash of $41,000. So remember, always use those title headings. So in this case, they're using sales commissions as their revenue accounts. So revenue accounts could be fees earned, it could be sales commissions, it could be rent revenue, it could be interest revenue. It just represents something that we are earning for providing a service to our customer. In this case, we're a real estate business. We are providing service of actually finding a real estate property for somebody. So that earns us a sales commission when we do that. So we're receiving cash. So anytime we receive cash, that's going to increase our cash. So our cash is going to go up by $41,000. And the reason why we are receiving $41,000 in cash is because we've earned it. We've provided a service to our customers. So our sales commission is going to go up also by $41,000. So we're going to update our balances once again. We now have $61,600 in cash, $1,900 in supplies, $500 that we still owe on account, $22,000 in common stock, and now we have earned $41,000 in our sales commission. In transaction E, it says we paid rent on our office and equipment for the month of $2,600. So paid, we know every time we see that word paid, we know that our cash is going to be affected and it's going to be negatively affected. So we are spending out cash of $2,600. And the reason that we're spending out cash, they told us, was for rent. So when we're looking at our titles, anytime that we've used an asset to help run and operate our business, that is the definition of an expense. So our expenses in total overall reduce retained earnings. So we're going to reduce our rent is going to have a negative impact of that $2,600. Again, the definition of an asset, or of an expense rather, is any asset that we've used to keep our business running and operating. So we'll update our balances once again. We now have $59,000 in cash. We still have the $1,900 in supplies, $500 that we owe for our liabilities, $22,000 in common stock. We still have $41,000 that we've earned in our revenues, and now we have $26,000 that we've spent in assets to pay for our rent. If we don't have a facility, it's very hard to offer a service to our customers. In transaction F, it says that we paid dividends of $3,400. So paid, we know that paid, E is what we missed. So we paid dividends of $3,400. So dividends are when we pay something out to our stockholders. Again, we've earned an income during the period. We want to give something back to them. Paid means that cash is involved. And it means that it's going to be negatively impacted. So we go to our cash once again. Again, we enter in that minus sign because it's reducing our cash. We are paying it out by $3,400. And dividends, just like expenses, reduce overall stockholder equity. It's reducing the value of our owners in total. So we update our balances. My cash is now at $55,600. Supplies still at $1,900. Liabilities still at $5,000. $22,000 for our common stock. We now have $3,400 in dividends. $41,000 still in our sales commission, which is again our revenue account, and $2,600 in our rent. In transaction G, it says that we paid an automobile expense for the month of $3,150. and a miscellaneous expense of $1,700. So $3,150 is going to our automobile expense, and then we also have $1,700 to our miscellaneous expense. So first word is paid. We know we're paying something in total. So cash is going to be reduced in total of $4,850. That's for the total of those two expenses that we have. Again, that $3,000 expense for our automobile, that $3,150, and $1,700 for miscellaneous. So it's affecting more than two accounts, and that's fine. At least two accounts have to be involved in every single transaction that we're dealing with, but there can always be more than two. So an expense is something that we have used an asset to keep our business running and operating. So we have an automobile expense in total of $3,150. And then we also have a miscellaneous expense of $1,700. So again, something decreased on the left side of our equation in that total $4,000 value, and then we're doing the same amount on the other side, but now we're breaking it between those two accounts, the automobile expense and the miscellaneous expense. But we still balance in total. So we again need to update our balances that we have. So we had $55,600 in cash. We just spent $4,850. So we're left with $50,750 in cash. Supplies still hasn't changed. Our liabilities have not changed. Our common stock has not changed. We still have $3,400 in dividends, $41,000 in revenue, $2,600 that we spent for our rent, $3,150 for an automobile expense, and $1,700 for a miscellaneous expense. In transaction H, it tells us that we paid office salaries of $4,300. So we're paying our employees for working for us. Again, the first word is paid, so we know that cash is involved, and when we pay out cash, we have less of it. So our cash is going to decrease by $4,300. And what we're spending that cash on is paying our employees. And remember, employees are not an asset to our business. We don't own them. We can't buy and sell them. So instead, they are an expense. They help us run and operate our business. So we are using assets to pay our employees. They are an expense to our business for that $4,300. We update our balances one more time. So we have $46,450 left in cash, $1,900 in supplies, $500 in our liabilities, $22,000 in our common stock, $3,400 in dividends, $41,000 in revenue. We now have $4,300 that we've used in assets to pay our employees for helping us generate revenues for our business, $2,600 in rent, $3,150 in an automobile expense, and $1,700 in a miscellaneous expense. And finally, in transaction I, this one's a little different. It tells us that they determined that the cost of supplies on hand was $800. Therefore, the cost of supplies used was $1,100. So remember, any asset that is used to help run and operate our business becomes an expense to our business. So they're telling us that out of the total $1,900 in supplies that we once owned, $1,100 of that has been used. So $1,100 of that has to become an expense for our business. And the on-hand amount, when it says on hand, that represents how much of the asset we still own. So we still own $800 of that $1,900 in supplies that we purchased, which means the ending balance in our supplies account should only be $800. We don't want to mislead anyone that's looking at our financial statements to say that we have $1,900 in supplies when we really don't own that. So in transaction I, it's not affecting cash at all. We're not buying any more supplies. We're not selling them off to anybody. But what we are reducing is we're reducing our supplies balance by how much we've used. So always make sure you're reducing it by the used amount. So we've used $1,100 in supplies, so we reduce it by $1,100. And again, the definition of an expense is any asset that we've used to help run and operate our business. So in our supplies expense, we're going to put in that $1,100. We've used $1,100 in supplies to keep our business running and operating. So we're going to do a final total. So we still have $46,450 in cash. We now only have $800 in supplies, which represents that on-hand amount. We have $500 in our accounts payable, $22,000 in common stock, $3,400 in dividends, $41,000 in our sales commission, which is our revenue, $4,300 in our salary expense, $2,600 in our rent expense, $3,150 in our automobile expense, $1,100 now in our supplies expense, representing those supplies that were used, and $1,700 in a miscellaneous expense. So now that we have all of that information, we can use these very last updated balance values